Hi, and welcome to this week's market presentation. Latest news. Signs of a slowing U.S. economy continued to build following last week's jobs report for the month of August, which showed only 22,000 new jobs added over the past month, far below the 75,000 new jobs that had been forecasted. The unemployment rate rose to 4.3%, the highest level in nearly 4 years. And as a result, pressure is certainly continuing to build on the Federal Reserve to move forward with interest rate cuts at their next meeting on September 17th. Equities and Treasury yields fell sharply following the release of the jobs report, and markets increased their probability of a rate cut up to 100%. Over in Japan, following the 2025 parliamentary elections that saw the governing ruling coalition lose its majority, Japanese Prime Minister Shigeru Ishiba resigned. Ishiba's departure less than a year since taking office has ushered a period of political instability and policy uncertainty for Japan. His resignation and especially uncertainty over his successor has triggered some market volatility, with the Japanese yen falling and investors watching whether future leadership will shift economic or monetary policy. Weather. Over to the weather forecast, we note the forecast of rising temperatures compared to the seasonal average over the next 7 to 10 days, following the past week and the beginning of the week where temperatures have been slightly below the seasonal average, particularly over in Western Europe. Temperatures are still expected to be more moderate as we move into September and we leave the hotter summer temperatures, which will help ease overall power and gas consumption. In terms of precipitation, we see greater levels of precipitation, particularly in the Nordic region over the next 7 to 10 days, especially in the second half and late parts of this week. In terms of wind speeds, we're also expecting an uptick in average wind speeds across Europe, which are expected to increase wind power generation over the same period of time. Microeconomics. Moving on to the microeconomics, we have now PMI figures for the month of August. For the global economy, we saw a relatively stable situation with the composite PMI increasing by 0.5 month over month and still remaining in growth territory. Looking at the composite PMIs for different regions, we see figures for the US, which saw a slight deterioration from 55.1 to 54.6, while over in China, we see a similar stability there with limited movement in terms of composite PMIs. India and the UK, on the other hand, saw a slight uptick there. A closer look at the split between the manufacturing and services sector, we see that in the US, the manufacturing sector saw an uptick over the past month following a couple of months of decreases. Over in the service industry, we technically see a more positive picture with the service sector, particularly over in Western Europe and North America, pushing overall economic growth. Crude oil and LPG. Moving on to crude oil prices, we saw a bearish price evolution over the past week, with prices decreasing around 2% for the front year, with some sharper decreases for the front month of around 3% week over week. On the demand side of things, we continue to see weaker global demand expectations due to the ongoing trade wars initiated by the US and its impact on global growth and demand. On the other hand, the prospect of interest rate cuts in the US could boost domestic consumption in the US, and as a result, we could see that add some upward pressure on crude oil markets. In terms of global supplies, however, the prospect of additional sanctions being introduced against Russia by the US and the European Union following the passing of the deadline set by President Trump for progress regarding a conclusion to the war in Ukraine could reduce and tighten global markets. At the same time, limiting the pressure due to the supply outlook is a decision by OPEC Plus to continue its production increases. The group announced that it will be increasing production quotas roughly 130,000 barrels per day for the month of October, in what has been a continuous increase in quotas over the past months.
Natural gas.
In terms of natural gas prices in Europe were relatively stable over the past week, moving up just around 1%, particularly for the front year and for the remainder of 2025. Overall, prices have remained lower than they were a month and lower than they were 3 months ago. In terms of storage levels increased to just under 80% as of the end of last week, with the injection rate ticking up compared to previous years and moving up to near the top of the range over the past 12 years. This is in contrast with the sharp decrease in injection rates that we saw over the last couple of years. The uptick in injection rates compared to previous years has helped narrow the storage deficit noticeably, moving now to below 15% for the first time since the end of last year. Looking at the storage levels across European countries, we see a generally more positive picture, particularly amongst Western and Southern Europe. Germany, however, remains below the European average at 74%. And overall, European countries are now just 10.5 percentage points below the 90% target set by the European Union, which at the current pace of injections should be met before the deadlines. Looking at total supply and demand, we saw total demand drop over the past week, primarily driven by improved weather conditions with lower temperatures easing cooling demand. Total supply, on the other hand, saw decreases as the Norwegian maintenance season plows ahead with sharp decreases in exports from Norway. The decrease in Norwegian gas exports was to some degree supported by an increase in LNG sendouts and LNG imports into Europe. We see that here where Norwegian gas flows have dropped in line with previous years, now in line with the average over the past 5 years. And so far, we have not seen reports of additional maintenance being needed there, easing some of the volatility and pressure on the market. In terms of LNG sendouts, they have compensated for the drop in Norwegian gas flows, and we're also seeing an increase in LNG imports into Europe over the past week as demand in Northeast Asia particularly begins to ease as temperatures there also cool down. In terms of price competition with Asia, the cooler temperatures is resulting in lower demand for new LNG imports into the region. Adding to some of the better sentiment is also the fact that U.S. LNG exports have been at a record high over the past month, especially over the past week, following the end of some maintenance across a couple LNG terminals, and also the faster progress on a new LNG export terminal in Louisiana, which is moving ahead of schedule. Investment funds continue to shed their long positions in the market, bringing those down to the lowest levels since the second quarter of 2024.
Coal.
Moving on to coal prices. Coal markets saw a bearish price evolution over the past week with decreases across the board. The main drivers of the decreasing pressure on coal prices was one, the lower overall demand levels that we see in particularly in Europe, but also in Northeast Asia, as temperatures are starting to move in a more favorable direction. Regarding the coal supplies, however, we are seeing some concerns over Russian exports following the fact that Russian coal sector in the first half of the year saw deep financial losses, with net losses reaching $2.31 billion. This is in contrast to the $88 million profit they had in the first half of 2024. The impact of falling global coal prices, rising production costs, and the ruble appreciation, on top of the Western sanctions that are reducing export markets and limiting the leverage that Russian exporters have in setting prices, is adding to a poor outlook for the Russian coal sector, which, if the situation worsens, could lead to tighter global supplies if we see a reduction in exports.
EU and UK emission allowances.
Over onto emission allowances, here we see a bullish price evolution, with prices for both the European and UK markets increasing over the past week and being rising over the last few weeks. Here, the upward pressure on the market is being driven in the short term by the compliance deadline coming up on September 30th, adding some more urgency to buyers' demand, And also, as we now look to 2026, expectations of tighter supply and demand conditions there as well. In terms of overall emission levels, however, and limiting some of the gains we're seeing in the market, power sector emissions remain at the lowest levels since at least 2019, notably below where we've been in previous years for this time of year, and boding well for lower emissions year over year. Investment funds, however, are taking note of the increase and the bullish tendency in markets, and we've seen net long positions in the European allowance futures increasing week over week. Over in the UK, those remain at near record highs, still on the expectations of that linkage between the European and UK markets.
Electricity.
Then moving on to electricity markets, electricity prices saw an upward price evolution over the past week, with the front year increasing around 2%, in line with the evolutions that we saw in the gas and carbon markets. Certainly the bullishness there adding upward pressure to power prices here as well. The price evolution across other European countries was very similar to that of Germany, with prices increasing across most European markets over the past week. Over in the Nordic region, some of the upward pressure was blunted by the weather forecast improving the hydropower outlook for the region. In terms of total demand and residual load, we note the decrease in both over the past week. Residual load now at the lowest level since at least 2019, with a similar evolution for total grid demand as well. Main driver of the lower grid demand is certainly the cooler temperatures we've seen over the past week, easing cooling demand across the continent. In terms of the supply mix, we're now just starting to see solar power generation peak and starting to come down. As you can appreciate here, there was a significant increase in the share of solar power output this year compared to previous years, with a notable increase from around 15% peak of power share last year to this year closer to 18%. On the other hand, we did see disappointing wind and hydropower generation so far this year, which then led to greater demand for fossil fuels, particularly natural gas. Nuclear power generation over the past week saw a slight decline driven by decreases in the French output as strikes impacted roughly 3.3 gigawatts of capacity. The strikes are expected to continue and impact production over the next week as well. Moving on to renewables and fossil fuel power generation, here we see the impact of the decrease in total demand for electricity, resulting in a decrease in fossil fuel power generation. The stable renewable power generation over the past week remained at the highest levels over the past 5 years, as you can see here. Taking a closer look at the renewable output, we've seen that uptick in wind power generation moving above the past 5-year average noticeably. As we now move into the fall, the expectation is for a structural increase in wind power generation as weather conditions are more favorable towards wind power output. On the other hand, solar power generation has continued the gradual decline over the past week, moving on from the peaks we saw in July and August. Nonetheless, solar power output remains at a record high for this time of year. In terms of fossil fuel power generation, natural gas-fired power plant output saw a decrease over the past week in line with the decreases we saw in total demand due to the weather conditions and the stable renewable output. Demand for fossil gas-fired power generation is now at the lowest level seen over the past 5 years. Coal-fired power generation has been more stable at the bottom of the range over the past 5 years as well. In terms of hydro reservoir levels, we've seen a deteriorated picture across most European countries. In the Nordics, Norway's hydro level went from an excess versus the average over the past 10 years to a deficit for the first time over the last 6 months. Similarly, the surplus in Sweden has continued to narrow to just 6% as of the end of last week. Over in other countries in Europe, with the exception of Switzerland, we've seen the excess or deficit versus the average worsen over the past week as the drier weather has continued throughout this summer. Lastly, looking at the evolution of guarantees of origin, we saw a pretty noticeable bearish price evolution over the past week, with prices decreasing most notably for 2025 production year, but continuing throughout the forward years as well. Here, the expectation of greater supply of renewables, particularly as renewable output so far this year remains at a record high, is one of the reasons for the slight increase in supply expectations for guarantees of origin. On the other hand, demand has softened as well due to that uncertain economic outlook, which has been weighing on markets throughout the year. Overall, the situation remains somewhat more volatile with quite a bit of movement over the last few weeks. Certainly as we get closer to the fall and the winter, we'll then expect more movement as we near the end of the year. That covers this week's market presentation. Thank you for joining.